Welcome, traders. I'm thrilled and excited to welcome you at our very first session of the second ARAS Marathon. My name is Nastasia. For those of you who haven't met me yet, I took my first live trade at 18-year-old and have since then been trading futures through the ARAS platform and refining my strategy and ultimately building a volume-driven approach that revolves around the market logic, order flow, and participants' behavior. Today on this webinar and the next 5 lessons, I will do my best to teach you exactly what I trade myself. So no fluff, no water, no holy grail promises. However, just a cause and effect price action and the real motivation behind every single print on the tape, every single tick in the footprint, and every single high volume node in the volume profile. So traditionally, before we're going to get started, let's run a quick tech check. Can you please let me know in the chat if you can see and hear me? And if you can hear me, can you please put a plus in the chat if the sound is good and we are ready to get started and dive into the topic of our first webinar of a new series. If you can hear and see me well, can you please put plus in the chat? Fantastic. I see some pluses. Thank you so much for the feedback. Thank you, and excited to see every single one of you here today. And one more thing, I have one more question to you. Do we have anyone today with us who have watched the previous series of the webinar? Because in April, we hosted the first marathon that contained 7 webinars altogether. And the purpose of the first marathon was to build a foundation of the logic behind the price movement. So if you have watched the previous webinars, if you have been with us since April 2025, can you please put 1 in the chat? Can you please put 1 in the chat? I'm glad. I would be really glad to see the familiar faces. Yeah, Paul, I remember. Fantastic. Ali also, good to see you. Michael is here as well with us. Welcome, Michael. Alex is here. Good. Hi, Lou. Brian, Dieter, thank you so much. Thank you so much for your trust, for being here with us today. And it's amazing to spot some familiar names in the chat. So, as I said before, the first marathon was about the basics of order flow and the volume analysis. So its mission was to give you a rock solid foundation. And don't worry, if you haven't watched the first marathon, the recordings are available and you can access the playlist on the ARAS YouTube channel. Okay, so this marathon, the next 5 lessons are going to take us even deeper. So you will be uncovering the advanced logic behind every single price movement. You will be learning about the market phases, which we're going to start diving into today. And we're going to be translating the raw analysis into a structured trading plan. So like we say, there is a top-down analysis. This is how we also host our marathons. From the top, from the general knowledge and the foundation, to the down, to details, to the precise entry points and action. So what we will be diving on today's webinar is that we will be kicking off with our market context and price action scenarios. So, okay, this is a topic that is absolutely critical for every successful intraday trader, but also for swing trader and also for scalpers, because no matter which type of trading you prefer and that fits your needs best, apologies for that, and no matter which one fits your needs best, you need to be able to build the frame and the foundational understanding on what is happening in the market. So today, we will be talking about, first of all, why context matters and why must you read the broader action of the price before hunting for a specific entry. We will also be talking about the market auction theory 2.0. In the previous series, we talked about the ask and bid distribution. We were covering also the depths of market, the smart tape, the footprint charts. And today we will be tapping into the modern take on how auctions really evolve. Okay, so we're going to be talking about the market phases as well. Accumulation, manipulation, distribution, how they rotate through balance, imbalance, impulse, profit taking, and the new balance. Some of you perhaps have heard it before, and for some of you, those will be a completely new concepts, but do not worry, we're going to take it slow, step by step, and if you will have any questions, I will be here to help you. Now, and also we will be, of course, connecting it to the volume as a phase thermometer, let's say like this. So why traded volume is the key indicator for every single stage in the market, no matter which stage we are in manipulation, in accumulation, or in distribution. At the end, traditionally, we are going to have a Q&A session. So make sure that you log in all the questions that you have as we go. You also might send them in the chat, and do not worry if I don't answer immediately, I will be coming back to them later. And quick heads up before we're going to get started, Angela is in the chat under the Adas nickname. She will be handling any technical issues you might have or questions as well. So big thanks for her for being with us on today's webinar. So plan about for 1 hour of focused work. And if there is anything unclear along the way, please make notes and we will uncover this and dive deep into the answers in our Q&A in the end of the stream. All right, let's jump in. So why context comes before the entry signal? This question is especially relevant for scalpers because scalpers are the one who always ask myself, why do I need to look at the bigger picture if I'm trading on 1 minute time frame? Well, the context matters because before you pull a trigger on any single trade, you must size up the market context, so the bigger picture in which your potential setup is forming, okay? Beginners, especially, often tend to really zoom in on entry signals and forget about the backbone on any analysis. The result of it? Well, you spot what looks like a textbook example, for example, right? And you jump in this trade and the market instantly goes against you and goes to your stop loss. Does it sound familiar? Let me know in the chat if this ever have happened to you. It definitely happened to me in the beginning of my trading career. Sometimes it might happen to me even now, right? If I underestimated the market context. So you enter the market, everything looked perfect. It was your textbook setup example, and it still goes immediately to stop loss. Yeah, it happened to me as well. Shabhan, Usman, Mateo, you're not alone. Every single one of us have been there and experienced this as a trader, and it's completely okay as long as you take knowledge and as long as you take this experience and transfer it into knowledge and building the bias for the next trades. So this situation, when it's a textbook example and still goes to our stop loss, happens usually because we ignore or not pay enough attention towards the surrounding conditions of this specific trade. Context, you can say, is the story essentially to the left of your chart. So everything that's been happening before. Or in other words, it's kind of a landscape around your setup. Key levels, or for example, current trend or a range, what the big players are doing. In short, a signal has to make sense inside of the current big narrative and the bigger picture of the market. Otherwise, the odds of a false trigger increase drastically, okay? So why is the context so crucial? Well, because it also filters out low quality trades. It helps you to know when within the market it's better to stay away and when it's a time to execute and maximize your gains. So suppose, for example, think about the idea. Imagine that your system gives you a signal for a long trade. But at the same time, the higher time frame trend, for example, or their market context around it, essentially shows you that the momentum is currently to the downside. So going long in a freight train circle downtrend is asking for pain from the market. It's literally asking for pain because the trade will either stall or flip red immediately. Okay, so when a signal clashes with the dominant direction, we skip it. We don't force it. We don't try to hope, because hope is not the strategy. So I quickly figured out that if I allow myself to ignore the bigger perspective, I'm going to regret it later, and I'm going to pay big time by my own money. On the flip side, if a setup that aligns with a larger market flow gives you a signal for the entry, or for example, it aligns with the dominant balance or the macroeconomical forces, this one has a far higher probability of being a profitable trade. So context also has a time component. Not only the price and not only their technical and fundamental, but also timing matters. Some of you who watched the first series of the webinar remember that we talked about timing and determining the best weeks, best days, and best hours to take an entry. So your time of the day or phase of the trading session really makes a difference. So the open can be highly volatile, for example, opening of the market. Midday often goes flat in between trading sessions, and there are profit taking or positioning flattening volume spikes before the market closure. So knowing these rhythms tell you when to press a buy or sell, or when to sit on your hands and stay out. Okay? Thank you so much, Kyle. Really appreciate it. And thank you for your trust. Thank you for being here today. So coming back to the point, context is also about the market state. So is the price right now in balance? So-called range or consolidation or flat, however you want to name it, or imbalance, which is a trending market. So we'll dive into this in a moment, but the bottom line of everything that I've been talking about for the past 10 minutes is that range tactics and trend tactics are completely different animals. Okay, so what brings you money in a chop can absolutely destroy it in the trending market and vice versa. This is why you have to have different approaches for when the market consolidates and when the market trends. For every single one of you who are joining us right now, welcome to the stream. In the end of our stream, we're going to have the Q&A. So if you have any questions, please let us know in the comments. And if I'm not coming back to them for a while, don't worry, I will definitely do this in the end of our stream during the Q&A session. Okay? So before starting the specific entry point, always go through this context checklist. Feel free to take screenshots. Please feel free to, make a notes for yourself, because this is something that I use on a daily basis, and this is something that filters out for me the bad ideas in the market. First of all, the trend alignment. The question is, does my idea run with the dominant trend on the higher time frames? Or am I completely fading freight trains and trying to only see the market through the microscope? We talked about this in the first series of the webinars, first marathon, that, for example, footprint is a great tool to confirm the entry. It's an amazing tool to confirm the momentum and time the perfect entry point as well as the exit point before losing the running profits. However, I always combine footprint with a high time frame volume analysis, because it allows me to build the context, to build an understanding of the potential of my trade ID. Am I trading against the trend? Then I should be expecting the lower potential risk to reward and lower amount of ticks gain than if I would be taking a trade within the big high time frame trend. Okay, so the trend alignment is the first. Secondly, nearby levels. Am I buying straight into the overhead resistance or selling into the concrete support? Am I buying and right above my price there is a big high volume node and a big volume accumulation area that is most likely going to act as a resistance and stop the price from moving higher? Am I buying straight into the big sellers activity? This is something that I need to check before I'm going to open the trade, because it also allows me to see the potential of the move. And does it even make sense to enter the trade like this? Or should I better wait, perhaps, for the pullback? And then when I have bigger space until resistances, supports, high volume zones, zones of accumulation, then I can actually wait and take a better position. Third, market phase. Are we in a balance? So where we can expect false breaks and, for example, mean reversions? Or am I in the trend? So I can look to join the momentum on the pullbacks. So this is also really important. Again, I said it before, so I'm not going to stop here for a long time, but to trade in a range and to trade in the trending market, two completely different animals, and requires at least two different approaches and strategies. And the fourth one is the macro timing. Are there any scheduled news that could blow up the chart, for example? Are we near the session closure when the big players usually flatten? Or are we right in front of the, for example, New York opening, where there will be a spike in the volatility and sometimes high market manipulations? So these 4 questions, 4 points in a checklist, those are your snapshot in a trader's homework before every single trade. I usually say that if you do not have the answers to those 4 questions, then you shouldn't be in the trade in the first place. So running this checklist literally takes seconds or maybe 2 minutes, but it kills countless impulsive mistakes that we usually lose money on when we trade. Smart traders don't trade signals completely being zoned in their own vacuum. They trade signals which align with the context. Okay, so if the backdrop isn't supportive, then simply pass and let it go. There always is another trade coming. So that single habit, that to check your context checklist, can boost not only your confidence and accounts, but also the win probability, and it can slash unnecessary losses that otherwise you would take. By the way, Angela just posted the link to the previous webinar series. So if you want to build a strong foundation within the smart tape, depth of market, footprint, and volume basis, please, after today's webinar, go and play the playlist and build a strong foundation. Come back to the next webinar already stronger and more knowledgeable. So context is the king. For us as traders, it's a totally king. So with that principle locked in already, let's move to the framework that lets you read the context structurally. It's called the auction market theory. If you have ever heard about the auction market theory, can you please put a plus in the chat? And if you haven't, can you please put a minus? If this is the first time you see this type of chart, can you please put a minus in the chat? If you've already heard about the fair value volume distribution, can you please put a plus in the chat already? Okay, I see some of you already have. Okay, yeah, we have some pluses in the chat. We also have some minuses. That's great. Good. We have some people who are just starting with this principle and some of you who already have some experience. Okay, so I'm going to go through this and then we're going to dive into the deeper knowledge for those of you who have the base. In a couple of minutes, we're going to go to the more advanced things. So the market auction theory 2.0, and that's how our essentially marathon name is named as well, that it comes down to analyzing price action, volume distribution, and market profile. At the core, this model views the market as a continuous auction between buyers and sellers negotiating for the fair price. Because what is the market? The market is an auction. And we talked about this when we were coming through the depths of market theory and the distribution between asks and bids and how the orders get filled in the first webinar of the first series. So let's take this idea one step further with a modernized take. so let's say an upgraded lens that integrates the reality of today's very fast-paced markets and the power of volume analysis. So we're going to be combining this with volume in a minute. At the heart, the theory is very simple but extremely powerful. Price moves because of imbalance between supply and demand. This one statement lays as a core, as a foundation of the market auction theory. Meaning, when aggressive buyers dominate, price rises. So if we have more aggressive buy-by market orders, price goes up. When aggressive sellers take over, price usually declines, drops. So if market is hit by the big amount of aggressive sell market orders, the price is usually going to decline, and so does the delta. So the market is constantly searching for the price where both sides, buyers and sellers, are willing to trade, or it's so-called the temporary balance, because nothing in the market is stable, it cannot last forever, but it's a temporary balance where buyers and sellers both agree on the current market price for the asset. This process unfolds in the form of an auction. So sellers offer their own, stakes for this specific asset, and buyers bid on it. So if, for example, price moves too high and becomes unattractive for buyers, demand rises up and price usually drops. The demand dries up, right? And price usually drops. On the other hand, if the price falls too much, and we see such movements recently in the market because of geopolitical events and macroeconomical events as well, we have very sharp moves in the market. So if the market drops drastically, right, and too fast, sellers are no longer interested in selling at so low prices. So supply disappears and price usually either stops and consolidates or start climbing back up. Eventually, price gravitates towards a zone where both sides actively engage. This also lays in the principle of high volume nodes in the volume. So the high volume node is where a lot of activity of traders was happening, hence why is a high volume node is usually a fair price zone, fair value zone. So this area becomes the value area if we're talking about the market profile or volume profile. Remember, right, the value area, fair value, is about 70% of the total traded volume for the specific period of time. Or we also can call it a balanced zone, where trade is most attractive, price is most attractive for this specific asset, and considered fair by both buyers and sellers. And here comes the crucial moment. Now, I want you to make some notes on that because this is going to be impacting the zones where you trade. Extreme prices rarely attract lots of traders. So, because no one wants to be buying too high at the highs, and no one wants to sell too low. Okay, so obvious price extremes, volume tends to really drop at them. So you will see that if you use the volume profile, I'm going to have a look at that later as well in practice, that usually the highest volume is distributed in the middle or more or less in the middle of the move. It's really rarely when there is a high volume right at the top or right at the bottom of certain price movement. So these levels where the market so-called rejects the price, right? Market participants don't want to trade there, you will often see reversals from those zones because the market just doesn't accept such prices for those assets. So that's how the market behave, right? They explore essentially prices until they find the ones that participant accepts. And once both participants, buyers and sellers, accept it, volume clusters and balance zone form until something happens in the market, the geopolitical or macroeconomical background changes, and the next imbalance forces a move again. Because if the macroeconomical or fundamental geopolitical background changes, then the assets price, the fair assets price in the mind of traders usually also tends to change. And the market exits the balance, goes into imbalance, and goes search for another fair value price. So this dynamic balance, imbalance, new balance is essentially a heartbeat of the movement. So when you will be able to learn these phases through the structure, right, and volume, you no longer will be reacting to the price because you will be anticipating the next move in the auction in advance. So now let's go deeper and see how these phases play out and how to spot them. Okay, so this picture clearly illustrates the principle of the auction. A price that fails to attract counter interest will not hold for long. Okay, so the extended 2.0 market auction theory, which we are doing here on this marathon, includes several key principles. First of all, the market alternates between balance and trend phases. So in balance, in their efficient market, which is efficient for both sides, okay, supply and demand are roughly equal, more or less. And activity of aggressive buyers and sellers also more or less is equal. We will also see the more or less equal delta, right? Because the more or less equal amount of aggressive buyers and sellers will bring delta to the lower numbers. Okay, because delta, as we remember from the first marathon, is the difference between asks and bids, aggressive one. And volume profile in the zones of balance, in the efficient zones, will take a bell shape because the volume in the zone of the balance will be increasing. The more people trade, the more volume increases, meaning that in the fair value zone, price is interesting for both buyers and sellers, hence why it also consists from the bigger volume accumulation areas. But the balance is always only there for a while, right? It's not stable, it's not forever. So a phase of imbalance sooner or later emerges and price enters a trending move until a new balance is found. So research shows that the market spends significantly more time in balance than in a trend. And if you remember also in the first series of the marathon, I was bringing up the picture where I was studying it myself, and 70% of the time on any time frame, on any asset, even the trending assets like Bitcoin or mini S&P 500, Nasdaq 100, and so on, price tends to spend in the range 70% of the time. And now we know that range is also called balance. So the market spends time in a balance, right? More than searching for the balance. So more than in the trend. Many of you have also probably noticed how the price can remain in a sideways range for weeks and only trend for one single day. And then we are like, oh, I waited for this move for 2 weeks and now I missed it. Well, you're not going to miss it if you will be aware of this exact structure and you will know how the market actually moves. It's because price has a memory in form of the volume profile. On a volume profile chart, it's very easy to see which levels had heavy volume, and these are typically value areas or balance zones, and they attract both buyers and sellers. The market, on the other hand, tends to return to these areas because there is a lot of unfinished business, unfinished auctions, and the trading continues there to fill in those unfinished auction zones. On the other hand, volume gaps on the profile, so low volume nodes, right, or vacuum, however you want to call it, they mark price zones where interest was really low. So that was inefficient market, the side of the imbalance when the market was trending. It was inefficient, it was imbalanced, it was unattractive to one of the sides, buyers or sellers, hence why there was lower volume and low volume nodes. These zones, these low volume nodes, usually are less likely to hold the price in the future as well. So it's impossible. Now, I want you to know this. It's not a holy grail, and it's impossible to predict price movements with certainty 100%. But what we can do as traders is to logically assess participants' behavior. Auction market teaches us not to think in terms of 100% forecasts, but in terms of probabilities and scenarios, where participants are likely to consider price fair, for example, and where they might begin to buy or sell aggressively. And for the help, we use volume and footprint. So the influence of large and small market participants really differs significantly. For example, large, long-term or high-frequency trades, like funds or financial institutions, they aim to build a large positions and drive the market into trend. So they tend to build their large position in the balanced while the market is efficient, and then drive the market into inefficiency, into imbalance, into the trend, because that's how they make money, right? And they are usually the ones who move the auction. So smaller intraday traders like you and me and every single one of us on the stream tend to trade within the established ranges, and we react to the local changes of the price, local fluctuations. That's why as scalpers, intraday traders, but also as swing trader, we want to monitor and understand the behavior of large capital, especially when they move the market out of balance in the trend. And there are two types of setups in the market auction theory, so responsive trades and initiative trades. Okay? So responsive trades occur within the current balance, within the efficient market, from edges of the range towards its center, for example. The point of control is usually in the center of it. This is a play on preserving the status quo. Okay, and for example, selling at the top of the range, expecting price to return to the middle, or buying at the bottom of the range, expecting the price to bounce back up. Those are the responsive trades. And usually they're considered as more predictable, and targets are within the point of control of the range. Initiative trades, on the other hand, are the trades which are executed in the inefficient, imbalanced market on the right side of our screen, betting on the new trend as the price escapes the balance. So in this case, we are stepping into some kind of uncertainty, and stops and targets are harder to define in advance because the market is searching for the new value area. So initiative trades carry more risk normally. So like, for example, you can fall into the fake breakout or rejection that you don't anticipate, but they also carry more potential reward, because if you can spot the real breakout from the range, you will be able to make profits on a really strong impulsive move. Modern action theory really uses lots of volume analysis as an essential component, because volume acts as a measure of the success or failure of the price movement. So if the price attempts to break out of the range, but volume drops, for example, the breakout is likely to fail, and there is no participation from large players. But if there is a large volume surge during the breakout, that's a sign that market has truly shifted balance, and actively trading is already at the new fair price levels. So let's quickly summarize the auction market theory before we're going to move on. First of all, the market is an auction where price either stays in balance zones, in efficient zone, where it's temporary agreement between supply and demand, between buyers and sellers, or breaks out into impulses to find the new balance. And those are inefficient markets. Our job as traders is to recognize those periods of time, to transition between them profitably, trading either within the boundary of a balance or within the momentum of imbalance. Okay, so now let's have a look at the specific model of price movement that is shifting between the phases. Okay, and we're going to be talking about their accumulation, manipulation, and distribution in a second. But if you will be applying the volume profile, what you will be seeing a lot is that instead of having just a theory of fair value, you will practically be able to see and recognize the fair value in Atas platform, applying the market profile and TPO indicator, which will be automatically drawing the volume profile or market profile for you on the period of time that you select. So when the market is ranging, it's in the balance, it's in the efficiency, and the volume increases because more people tend to enter trades. More people consider the price as fair, and on the other hand, large institutions, large market players start to accumulate their positions before pushing the market out of balance. After the zone of imbalance starts the imbalance period of time, when the market drives in a trend and less volume occurs there. So less people tend to trade in the imbalance period of time because it's an unattractive price, first. Secondly, because it carries more risks. It's uncertain. This is why it's also called imbalanced or inefficient market. And then eventually, after some time, the price is going to find the new balance and go in the new sideways range. You will be able to recognize it using, again, the market profile and TPO on the Atas platform. And you will be able to see that market profile shows the increased histogram, more volume in a period where market does what? Consolidates. So the market consolidates and the volume increases. As you can see, the sharp movements to the upside usually carry the lower volume. So they usually require less volume for the price to move. It's inefficient market, and it usually is combined with the low volume nodes. Before we're gonna move on, can you please put 1 in the chat if you have already used the market profile and TPO indicator on Atas platform? And can you please put 2 in the chat if this is going to be the first time that you will be using this specific indicator for your trading? Put 1 if you have used it before, and 2 if that's going to be the first time for you to apply this specific tool. I see some ones, I see lots of ones, so lots of you have been practicing already using the market profile and TPO. Perhaps this is the base of your trading system even. And we also have some 2s and even 3s. I don't know what the 3 means, but okay. So yeah, perfect. So lots of you have been using it before. Some of you have never seen it before, and that's going to be the first time. But what I encourage you to do is now when you'll be using it, remind yourself to not only look at it from the perspective of the volume accumulation, but also remember that there are 3 phases in the market, okay? And we're also talking about efficiency on the inefficiency, and start to analyzing if the market is efficient, if the market is imbalanced, if the market is in imbalance, and build your trading system and the next trading decision that you take, not only based on the volume profile, but also based on those market phases. Talking about market phases, well, Mitya said, but I used it but didn't understand it. I do hope that after this marathon, you will confidently feel like you can go back to your platform, trading platform Atas, connect your account and start confidently trading using market profile and TPO tool. So talking about the phases, okay, let's move on toward the concept of accumulation, manipulation, and distribution, which in other words is called the AMD model. This is really widely recognized model that explains how large players, so again, big market players, institutions, high frequency traders, move the market through a sequence of phases. Understanding those phases helps traders avoid the traps set by the big money participants and trade with them and not against them. To understand why do you need to do this is we can bring out the statistics. 80% of traders lose their money. Only 10 to 20% make money. On the other hand, big market players, institutions, hedge funds, high-frequency traders, they usually make money, not lose money. So you want to be able to join the winning side, and for this, the phases of the market combination with volume profile can drastically help you and bring you closer to achieving this goal. So in a very classical view, before we're going to add anything to it and the volume understanding, the IMD model unfolds as follows. First is the phase of accumulation. So large players begin building their positions, either long or short, it doesn't matter, within a relatively narrow price range without causing significant price movement. So the price just goes sideways. In this phase, their goal is to accumulate their positions and accumulate the volume quietly without making noise or drawing attention of other traders. So they're trying to hide their trades within the accumulation to not uncover and open up too early about the direction of their setups. Because imagine if you would be a hedge fund. Would you want the other hedge fund to know where you're going to be making money? Surely not, because you want the money for yourself. So the goal in accumulation is to hide the big volume zones, big volume accumulation positions. Next, manipulation. Manipulation, once a position is established, is used to create a deceptive price move. And again, we will be still talking about this again, but in the first marathon, we were talking about the trading method called the range, where you're waiting for the price to break out of the range, but for 70 or more % to confirm the real breakout. Manipulation usually happens to up to 50% of the size of the accumulation. This is a really important note to make, so please make some notes. Manipulation size is usually up to 50% of the size of accumulation. Okay? Usually manipulation has a shape of sharp, often short-lived spike or a drop, meaning to shake out retail traders and trigger their stop losses, capture liquidity before the real direction starts. This move typically goes in the opposite direction of the intended and followed up trend. And then the distribution. The distribution is what happens after the manipulative shakeout and stop loss hunts. The market begins a genuine trending movement. This is an execution phase. So the large players start offloading the position they've built, taking profits, selling to the crowd at the higher prices than they've bought, if they were long, for example, or buying back at the lower prices if they were short. And this is where a strong directional trend is born. So the key points in the IMD model is that market alternates always between the balance and the trend. So in balance, price moves inside of the narrow range, supply and demand are roughly equal, the volume profile increases, so the histogram increases, and periodically that balance break, where the phase of accumulation is ended and manipulation or distribution begins. Again, studies show that the market spends around 70% of the time in the accumulation and only 10 to 30%, depending on the market, in the actual trending movement. So many of you have seen price sit in a range for weeks and then just moving in a matter of hours or just a few days. Secondly, price carries memory via the volume profile. So on a volume profile, you will always be able to see the heavy volume traded, and those are the zones where the big market players were accumulating their positions. Price usually returns to those zones and collects the liquidity and uses them in the next resistance or support areas. Thirdly, as we said before, you cannot predict it to 100%, but you can logically assess it and build your own trading plan, thinking in the probability sense scenarios. Large and small participants have different impact. So the big market participants move the market, and we as small market participants want to join the big party. We want to be able to recognize where the big market participants are accumulating their position when they start pushing the market, and we want to join the movement. And to summarize it, we have two categories of trades in auction theory: responsive and initiative. Responsive are the ones that happen in the zone of accumulation. Initiative are the ones that happen in the zone of manipulation and distribution. Okay, so bottom line for their auction market theory 2.0 and the base of MDA model is that market is an auction in which price moves in balance zones, which are temporarily agreement between buyers and sellers, onto impulses, accumulation, distribution, and manipulation to create the new trend. Okay? Now, as we are looking at the accumulation and manipulation and distribution, let's detail each phase and how to spot it on the chart and what happens behind the scenes. In the accumulation area, price drifts sideways, and often after a long rally, for example, or a long drop, the price gets exactly in this phase. Volumes typically shrink before the accumulation starts and volatility dies. Visually, it creates a flat consolidation with an increase in volume by the longer time the price spends in accumulation. Smart money objective is to absorb the volume and accumulate their new positions before the new trend starts. So key clues how you can recognize it is the horizontal range, higher accumulation of volumes, no trend. Okay, for us, accumulation is a heads up. A breakout is coming sooner or later, but timing in that direction is yet unclear. So we are waiting for the next phase to enter the market. Although it might seem like trading from the edges of accumulation is the safest scenario, usually for me personally, I prefer to wait for manipulation and distribution before entering the trade. Manipulation starts. Suddenly, activity explodes and smart money pushes the price beyond the range, breaking either support or resistance depending on the situation, and creates an illusion of a move while pursuing a different goal to grab the liquidity, stop out traders, and collect their money before the actual real direction starts. So imagine that all stop losses of retail traders are parked just below the box. Retail traders usually completely put their stop losses below the previous supports, so the big market participants know this and trigger the fast, violent spike to execute those stop orders. Result is usually a stop run or a fast breakout with a very sharp increase in volume. So usually manipulation is a sharp volume spike, not a slowly increasing stably volume, but a sharp spike of volume, and then the price surges in the opposite direction. Distribution phase starts when, let's call us passengers, right? Small traders are already overboard, and the ship, the market, is set to sail. So the distribution mark is the start of the true trend and the direction where big players essentially monetize and profit take the positions which were accumulated in their balance, in their accumulation. If they were long, price goes in a steady uptrend because bigger market participants start slowly and steadily selling into strengths of eager late retail buyers. So if short, on the other hand, the price is going to be falling lower and the big market participants are going to be buying back into panic selling. The signs of distribution are the following. It clears out the range, so it gets outside the range. Previously, it went in the opposite direction to manipulate the market and kick the stop losses out. Manipulation characterizes with a spike of volume, while distribution is characterized with a steady increased volume along the trend. Okay, and it is essential to stress that IMD model is fractal. So these three phases can stretch across months, for example, or daily charts, or even the 1 minute charts, and unfold within as much as single trading session, and for example, over years. So no matter if you're a scalper, intraday trader, or a swing trader, knowing and recognizing those zones can lay a strong foundation into your trading system. Also for scalpers, sometimes people think it's not important, but it's really crucial, because by knowing these phases that the market is currently in, you know what to expect and you know when to scalp. If, for example, you are in accumulation, you do not expect the immediate large move, right? And you can cautiously trade inside the range as a scalper. If the market is in manipulation, you do not panic or chase the reactive trades in the direction of the first breakout. You basically wait for the dust to settle and wait for the actual direction to unfold. And once it unfolds and distribution phase starts, you can trade within this trend, yet obviously remaining aware about the profit-taking waves that will still appear in the market. Okay, so let's link this back to the market auction theory. We spoke about responsive and initiative trades. The manipulation phase is frequently that initiate breakout attempt from balance that proves false. Distribution, in the contrast, is an initiative breakout that succeeds and evolves a trend to a trend, while price remains into accumulation or a balance. Responsive trades fade in the range edge back toward the center are the most appropriate. So if you are trading within the range, at least trade from the sides towards the middle. I prefer to not trade within the range at all, and I wait for the initiative trades when the distribution and manipulation periods start. So having those phases outlined and understood, the practical question arises. How do we recognize at the real time the phase that we are in and when one phase is transitioning into the next? Well, volume is exactly for this. It's a key indicator that can help you to understand the difference between different phases. In accumulation phase, volume typically rises and stays above the average. So accumulation over time is going to be characterized with a very high increase of the volume, because that's where the big market participants accumulate their positions. If you are trading within this specific zone, the highest volume usually is approximately in the middle of the accumulation, in the middle of a balance, and you trade from the ranges, from the edges of the range towards the point of control, towards the center of the big high volume nodes. Manipulation phase usually characterizes with an abnormal spike of volume. So when accumulation gets to the end, we have an even higher spike of volume, and for this, you already use not the volume profile indicator, but the normal vertical volume indicator to spot the spike. A pulse breakout is almost always easy to spot by the vertical volume, because the moment stops are run, you will see a real surge on the volume bar. Okay, so imagine the stop run beneath the support, like in this example, because the market sell orders are going to be completely wiped out. The stop orders sometimes is going to be joined by the algorithm as high frequency robots. Somebody might take the other side, for example, and that somebody is the large limit buyer waiting underneath, and their vertical volume is going to show you the huge spike, while footprint is also going to print on a break, yet price will not be able to go any further. Usually you will see their high activity in the footprint, unable to break lower than the newly created support. And in distribution, in trading phase, volume generally gradually is created. It gradually increases or decreases, but it's lower than in the phase of the accumulation and not as aggressive as in the period of manipulation. Usually with time passing and the trend fading away, the volume is also going to be lowering down. So as the trend matures, volume slows down, yet as a key inflection point, for example, say a breakout of their level, the new bursts of volume are going to be appearing. So you can think of volume as a trend gasoline, for example. When it's flowing, the engine runs, and when the volume runs out, the move usually also fades into consolidation. And near the end of the trend, you will also spot a huge volume climax, because a sharp volume surge on the final bars, where the profit taken is final as well. And afterward, the market is again going to go into accumulation or a balance phase. So when big players start liquidating, they do so into public demand. And after a blow off of the volume near the highs, for example, like in this example, price can't go any further. It's likely to crash and then start accumulating again. So tracking volume dynamics is essentially how we read the smart money activity. Large orders cannot hide their volume accumulation zones. The combination of volume profile with vertical volume can help you to understand which phase you are now in, how much volume was accumulated, and how is the big market player behaving. You will be able to join the movement with big market players, and their question that you might have is essentially how to time the perfect entry when you already understand the overall picture, and like you need to be able to understand who is actually hitting the tape, buyers, sellers, and when is the time to enter. And for this purpose, we're going to be using the footprint charts. The combination of the footprint charts together with the method of IMD and also the balance imbalance theory and volume profile, we will be uncovering on the next webinar. So the next time we're going to be also talking about their deepening the knowledge that we established today. And we're going to be talking about the specific trade setups that you can apply immediately in any market, no matter if you trade currency futures, equity futures, cryptocurrencies, oil, other commodities, or anything else. No matter which time frame you trade, you will be able to combine their IMD model with volume profile, with vertical volume, and with footprint. And that's what we will be building further into the next time. Right now, as I promised, let's transition into the Q&A. If you have any questions, please do let me know in the chat. I'm going to go through the chat now to answer the question that I haven't seen during the current lesson today. And let us know what you think about today's lesson. If you have learned anything new, and if you are ready to go to your ARAS platform, turn on their TPO market profile indicator and see how their volumes are acting in the different phases, let us know. If you will have any questions next time, perhaps you will process the information that we talked about today. Please bring your questions also for the next time, and I'm going to be more than happy to answer them and help you with everything that I can. So let me go through the couple of questions that we already have. Tomac, they do not need the liquidity, right? But we also do need to realize that they don't need the liquidity is actually a very tricky question. Let's say you are a big institution. The market is an auction always, and the money flows between Tomac, you and me, for example, if we are two participants in the market. If I want to make money, I need to take it from you. If you are a big hedge fund, you need to take money from someone else to make profit. The easiest way to take money is to take it from retail traders. Paradoxically, you would be surprised that they are a liquidity of the market, but the big market percentage is actually belonging to retail traders. Just the volume is so distributed to the small pieces that it doesn't matter what I or you or anyone else does at their own trading account. What matters is the overall picture. But the hedge funds, financial institutions, high frequency bots, they need to make money by taking it away from someone. If they will be fighting against each other, it's going to be the tough fight. So what they do, they collect the money from retail traders, and those are significant amounts of money, trust me, around the world. You probably heard how people were liquidated for billions of dollars during the day, accumulated, right, during the crypto drops, for example, or during the crypto surges when people were short. So they actually do collect stop losses. You can see it on the footprint, you can see it on their volumes as well, because they are the liquidity, the big market participants, but we are their fuel and their profit. I hope it makes sense. Please let me know in the chat if this makes sense. William, not necessarily, no. The market is more in accumulation, 70% that in the distribution. That's true. That's what we talked about today. But it doesn't come down to only 3. It depends the time frame and the market you trade. Sometimes the markets are more active. Sometimes the markets are really slow. And the distribution phase is going to take, for example, weeks or months. Sometimes on the smaller time frame for the very active, aggressive markets, the market can go several times from accumulation to manipulation, distribution, and a new accumulation. If you will bring up the chart of gold from yesterday, then you will be able to see on the 5-minute time frame how the market several times entered accumulation, distribution, accumulation, manipulation, distribution. So in a matter of one day, we had several cycles happening. Sometimes it takes weeks, sometimes it takes days. Let's have a look at other questions. Vadim, thank you so much for the kind feedback. Kyle, let me answer like this. If the setup is not textbook clean, you might want to really think if you want to take a trade. You can also classify your setups. They might be super clean and they can be A plus setup, or it can be a bad, not so clean trade, and it can be an A setup. And you can use different types of risks for different classifications of your setup. The high quality setup can allow you to use more risks. The lower quality setups can allow you to use less risk, for example, okay? But you build confidence by practicing. Kyle, I would really suggest you, if you haven't watched the previous 7 webinars, go through them because we build the foundation of the volume. And please make sure to join the next one because I'm going to be showing also in practice how to use the volume, how to spot specific signals on the volume and footprint. And you can use those examples for your textbook and then rely on them. So I'd say classify your trades so you know the quality of each setup and you can adjust your risks accordingly. Watch the previous 7 webinars, attend the next 5, and use what I'm going to be showing in practice on the next one on your own charts to backtest and train. In the end of the day, our confidence in our own trading comes from practicing, backtesting, and ensuring that the system we use is profitable. What is a fake manipulation? Very interesting question. Manipulation by default is usually a fake out. Can be just a weak, yes. Manipulation can be a weak, manipulation can be a fast move, but it's usually up to 50% of the accumulation zone. Most of the people know, and they have insiders information. You can look even on the interviews with hedge funds, and it's pretty clear, straightforward. A lot of the times you will also be able to see that when the tensions arise before something happens, a lot of hedge funds or the big investors cut their positions. So they withdraw their money, they profit take, and they go into the risk of assets. Alex, great question. I'm going to repeat it again. You use their vertical volume indicator to determine the manipulation. On the vertical volume, you're going to see the spikes of volume. So the spikes in high sells out of nowhere, not the gradually increasing, but the spikes of volume. And their distribution is not going to have a spike. It will be a gradually increasing and decreasing volume with how the market will be moving in waves. So manipulation is usually characterized with a spike of volume on the vertical volume indicator. I use ADAS platform, and I'm going to explain you why. Because ADAS platform takes data from the centralized exchange. So all the footprint numbers, amounts of asks and bids, and the amount of contracts traded and every single tick and every single price fluctuation is correct. When you trade on the platforms that only provide the data for the CFDs or Forex, you will only be able to see their bits and pieces from what your broker allows you to see. So the volumes on the platforms which are based on the CFDs and Forex are incorrectly counted. So I want to be able to rely my trading system, my money that I make, my bread and butter on something very specific. That's why I trade on ADAS. And if you are still new to ADAS platform, it's completely all right. It gives you their free trial where you can try it out, get familiar with it before purchasing the license. But I honestly can tell you that using ADAS platform 5 years ago was a breakthrough in my trading career completely, and I would never go back. Іван, дуже дякую за зворотній зв'язок. Game Odyssey, if most of the people around the world would listen to those things and trade like this, probably the market would change. But I'm going to tell you, for the past 8 years, I've seen 99% of traders using indicators, using price patterns, and all of these kind of things. And people use different things. That's why it is not based on the specific trading system, but based on the normal human behavior. Big hedge funds know the human behavior and emotional reactions, and they try to take profits using specifically our emotional weaknesses. When we get stressed, we get scared, we close the trades too early. Like, for example, people didn't make money on Bitcoin. Why? Because, well, they buy it when it's going high on the hype, and they sell it when it's going low on the stress and the fear. If that wouldn't be the case, and if people would be able to manage their emotions correctly, more people would be making money. But it's not. And hedge funds, big financial institutions, big market players know about that. Yeah, Kyle, I need specific confirmations. I usually use a combination of volume and footprint for this. I've shared some of the setups in the previous webinars, but I'm going to be sharing more practical setups on the next one. So the next time we are going to be diving into the combination of this plus the specific confirmations on the footprint and volume. So please stay tuned to that. Come to the next one. In just 2 days, we're going to be talking about that. Yes, Simon, exactly that. Correctly, yes. It doesn't always specify within the drop of an open interest, but sometimes yes, and definitely lots of liquidations and volume spikes below or above accumulation. Alex, fantastic. Thank you for your trust. If you have any questions, please let us know. We are here to help. No, you cannot predict in which direction the market is going to go after the accumulation phase. For this, you would need to be a market player who is accumulating these volumes, which is not possible. And if you will be able to see the distribution between asks and bids within their accumulation, it's going to be approximately 50%, 50-50. Now, what you can do is when the price gets closer to breaking out of accumulation, you can watch the footprint charts. And then you will be able to see the lots of accumulation. For example, if the price wants to break out to the upside, you will see accumulation of volume on the top of the range with increased high deltas within the footprint. I'm going to show you more examples on the next webinar and the practical application to that. Thank you so much, Timo. I really appreciate you. I remember you from the previous series. Thank you for being back and for trusting us and me. Yes, it's most likely a manipulation. In this case, it's better to wait. And William, another side of manipulation is that manipulation is usually up to 50% of accumulation. I said it before. So you take the size of the range, you measure 50% of it, and if the breakout is more than 50%, to be safe, 70 or more percent, that is a sign that distribution phase started and the new trend started. If the breakout is 50% or less, you are at the chance and the risk of getting in the manipulation. So I hope it helps. Yes, absolutely. I will do this next time on our next webinar. We are unfortunately closing off our today's webinar because we are together for more than an hour and 15 minutes. But next time we will be talking about the combination of this and practical application and setups to enter and exit the trade within the footprint and volume profile as well. So thank you so much for being here with us today. Remember, if you will have any more questions, please bring them to the next webinar. I'm going to be more than happy to answer all the questions. And join others if you haven't done it yet, because next time we will be applying practical examples. I'm going to be sharing with you the workspace. So make sure that you are ready. It only takes you 3 steps to download the platform. Go into the aras.net, signing up with your email, your username and password, and downloading the platform from your back office of the Aras website. Thank you so much. I will see you on the next one in just 2 days, and have a great trading week ahead of you.